stocks within various sectors which have been exporting, which should also benefit. I think the stocks which are areas of the market which would probably get pressured are to an extent those who have raw material prices which are denominated in dollars, in the sense they're importing some of these raw materials, or probably they're linked to the dollar in one sense. So I would think that the OMC sector, for instance, where the prices are based on parity with imported prices. Once rupee depreciates, the OMCs are under pressure to actually raise prices a lot more than that would have been otherwise. So as long as that gets passed on to the consumer, it is fine. But if there is a situation where the government is not able to, is not able to pass on, or the OMCs are not able to pass on because of political related reasons, then there could be issues. Obviously, the financial sector is also under a bit of a pressure because with inflation rising, with higher fuel product prices, obviously some of the NBFCs will feel the pinch from a cost of funds perspective. So broadly, that's the kind of picture from an earnings and PE multiple standpoint.
Well, that's the take on dollar here. But Mr. Pai, also interesting question. I think that should be, I think, in the minds of a lot of investors, a lot of viewers also here. Because when you're looking at IT stocks and you're looking at the rupee sort of revenue guidance or rupee revenue growth expectations from average consensus estimates here for FY19 or FY20 here, perhaps that would also be factoring in the way actually dollar has depreciated. So there is a rupee tailwind here. Now, if I look at those sort of growth expectations and if I look at the PE multiple expansion of the IT stocks here, that tells me that is it actually something that the market actually is now giving higher multiple, because the rupee revenue growth numbers are not actually shooting up to 15% or 20% of the last year IT stocks here, but broadly again the rally actually and the PE multiple expansion has been much more. So in your sense, do you foresee even a stronger second half in terms of calendar year for the last year IT stocks here?
Okay, so if you look from the long-term perspective, I think the INR has been depreciating vis-a-vis the US dollar between 3 to 5% on a yearly basis. This is more from a CAGR perspective, but from, there could be periods of time where it depreciates a lot faster, and there are periods of time where the rupee kind of appreciates or remains thereabouts. So if you look at FY18, we probably saw a 1 year of rupee appreciation versus the dollar versus depreciation. So that had pressured the rupee revenue growth in FY18. Coming to FY19, it looks like we will probably see a rupee which is depreciated vis-a-vis the US dollar. I think the street is working with numbers of 66 and a half INR to the dollar for the full year, which probably, if rupee remains pressured through the year, my sense is that those numbers will have to be brought down, in the sense that rupee will probably have to be pushed up to 67 or 68 or thereabouts, which will mean that rupee growth is going to be better. So I think what has happened as far as the IT sector is concerned is that okay, so we've had, I think, 2-3 years of a very tepid growth for the sector from a US dollar perspective, which kind of impacted valuations. So from a situation where some of these companies were overweight in the portfolios of institutional investors, they became underweight over a period of time, over the last 2 to 3 year time frame. And what happened towards the end of calendar year 2017 was a kind of a belief that there's going to be a growth pickup come calendar year 2018, because US economy growth was kind of picking up, and also there was talk of tax reform in the US, which would push up earnings for the US S&P 500 companies, which are the prime customers of some of the IT services firms. So I think those expectations kind of drove the stocks up, not so much the rupee depreciation part. But having said that, I think what you saw post the March quarter results is that the dollar revenue growth, the constant currency growth, if you look across companies, have kind of got, I would say, have been a bit more disappointing than what they were. The expectations have kind of been dashed to some extent compared to what the thought process of the market was. Market was expecting probably high single-digit kind of growth to come through for the industry per se for FY19/2018. I think that has been dashed. So we've seen fairly tepid commentary coming from HCL Tech from a organic revenue growth perspective. Infosys also given just a 6 to 8% kind of CC constant currency revenue growth. It's only TCS which doesn't give guidance, which is continue to sound reasonably positive on growth, and it's talking about probably a high single digit kind of growth. Wipro is also kind of disappointed in terms of its commentary on FY19. So I think the expectations of a fairly robust pickup in growth for FY19 has been dashed. So to that extent, I would say the stock should have probably moved down. But I think the recent depreciation we've seen in the INR has actually helped keep the stocks up. So I think so my take on the sector is that I think the stocks will probably languish here, probably move up a tad. So we had been negative on the sector for almost 3 years until December of 2017. And we kind of upgraded the sector to a tactically bullish view in March. Basically, our call was based on the fact that the institutions were seriously underweight the sector, and at the margin, we felt that the fundamentals were improving a tad, and we felt that the other very large sector, which the institutions were seriously overweight on financials, that was going to see a bit of a situation where things would get pressured on the margin. So we did see interest rates move up. 10-year yields have moved up from 6 point to almost like 7.8, 7.9%.
Sure.
So I would think that at the margin, financials getting pressured and a little bit of positive turn of events for the IT sector is what's driven the sector up. So to that extent, I would say that situation is probably going to continue even for the next 6 to 12 months or so. So we continue to remain tactically bullish on the sector, though we don't expect any kind of great returns to come through.
Over the next, taken, Mr. Pai.
6 to 12.
Absolutely, as you're saying, so tactically bullish if you are. Allow me to ask you, if you're tactically bullish on the IT sector here, what would be your top pick at present in the IT stocks? Could be the mid cap, could be the large cap. In fact, the mid cap IT stocks, again, they're given far more returns over the last 9 months here. So anything, if you like, in particular in the IT sector here?
See, we have accumulates, we cover about 7 stocks, 2 mid cap and 5 large cap. So we have accumulate ratings on 6 of the 7 stocks with returns being broadly around the current levels. So we're expecting maybe +5 to -5 kind of return across those 6 stocks that I talked about. And for the other stock, which is a sell, we've got a fairly large downside. So we think that as things stand right now from a valuation perspective, we think there is probably better safety in large cap versus mid caps. I think so. One of the things that we've been focusing on from a narrative perspective on the sector is that the growth pickup is very modest. We think it is going to be very selective, and when I say selective right now, when we reinitiated ratings in the sector in March, we were talking about growth being faster for TCS and HCL Tech. HCL Tech has kind of disappointed us. So it's still very selective. I think only TCS is probably going to show a faster growth in FY19 versus FY18. So it's modest, selective, and I think it's unsustainable. So in the best, I would say the best economic situation one is going to see in the US, which is going to be in 2018, along with the tax reform. If that is the kind of growth that the sector is going to see, my sense is growth is going to peter off in 2019 and beyond. And obviously one needs to also look at the economic cycle in the US. The expansion has been long in the tooth. We've had almost a 9-year expansion. Somewhere down the road, we think it's going to come to an end. And when that happens, our sense is that the industry growth is going to probably be slightly negative, maybe low single digit negative growth is what one's going to see in the sector. So that's something the market needs to be cognizant about. So we're basically taking the call that this is probably a tactical view. Structurally, we still think that it's a fairly low growth sector and not something that one needs to play for a 3 to 5 year view.
Absolutely, Mr. Pai. So just one short question again before actually we start talking about your stock ideas. On IT again, are you suggesting at present that perhaps maybe it's a time to be tactically bullish, but then actually you should not raise your growth expectations too high? From that perspective, somebody actually was investing in Mindtree, Tata Elxsi, Persistent, Cyient. The names could be more in terms of midcap IT, but I'm just trying to get a flavor here for our viewers. Are you saying that perhaps you should not raise your growth expectations too high, and perhaps maybe this year, next 6 to 9 months, that could be a good period, but then you have to be really cognizant about rising risk from the US economy here?
Yeah, absolutely. I think as things stand right now, I think my sense is that the street is kind of extrapolating strong growth that some of these companies have shown in the last 6 to 12 months. I'm talking about mid-cap IT services stocks here. Some of these companies have shown very strong growth, both on the top line and more so on the bottom line side. And the bottom line side in certain companies have been because some of the margins of some of these companies have been bombed out because of various reasons. So there's been a fairly strong earnings pickup because margins have expanded back, not to the previous levels, not to the high levels that they were previously, but versus the base, what which compressed base they had kind of improved. So I think the street is anticipating this strong growth to continue for a fair bit of time, maybe 2 to 3 year time frame. We think that that is unlikely. One, because we think that somewhere down the road, more likely in the next 18 to 24 months, US economy is going to probably turn down. And when that happens, we believe that the tier one stocks are probably better placed to gain market share. So one of the things that we worry us about on a structural basis with mid-tier IT services firms is the very high client concentration that they have. So top 10 clients form anywhere between 40 to 60% across most stocks. And we've seen this in the past that whenever one or two clients kind of ramp down or leave, that leads to volatility in revenue growth and earnings. And we foresee this, even good years, even in the last 12 months, we've seen this happen across various mid-tier stocks. So we see this phenomenon kind of accelerating if you have a bad economic situation in the US, which we probably foresee, post 18 to 24 months. So that's something one needs to be cognizant of. Already the stocks are trading anywhere between 18 to 22 times FY20 earnings, and we're talking of consensus earnings here, not my set of numbers, which are probably lower than consensus earnings
so,
at this time.
Mr. Pai,
so I would be saying that shift away from.
Absolutely, as you're just saying that perhaps midcap IT again is not providing that sort of attractive opportunities right now. But as I understand, since again you have some stock picks for us, so from IT where again we were talking about a sort of tactically bullish outlook for some months here, but then you have to be cognizant about risk. But then there are two stock ideas, as I know, which you think perhaps could be outperforming, and they actually really have some strong growth levers here. The first one from the exhibition pack here, Inox Leisure. You like the stock. There is a very strong release calendar this year. And also again, if I actually look at the stock, it's trading at very high discount at present to the PVR here. So tell us why you like the stock and why this stock actually should be bridging the gap between the Inox valuation and the PVR valuation here.
Yeah, so we like the film exhibition space specifically. I mean, within the consumer discretionary space, because we think that it's got fairly high entry barriers. The entry barriers largely come from the fact that these companies have got slots in the malls, the key malls in various cities in the country. They've got space within them, and very difficult to dislodge these companies over the next 10 to 15 year time frame. So I think the entry barriers are extremely high, which gives them fairly, and they are an oligopoly in probably an industry which is in its infancy. So that is the key characteristic which we believe is going to be structurally attractive from an industry perspective, which should deliver you at least low teen kind of revenue growth over the next 10 to 15 year time frame for this industry. So that being the case between Inox and PVR, why we like Inox a little bit more than PVR is because if you look at the average ticket price, if you look at the F&B spend per head, if you look at the advertisement revenue per screen, that's coming anywhere between 10% for ticket price, about 25% for F&B spend per head, and about 40-45% for advertisement revenue per screen, lower than PVR. And we think that Inox Leisure Management is taking steps to bridge the gap between PVR and Inox on these particular parameters. And F&B spend as well as advertisement revenue are very high gross margin businesses. So as the shift of revenue mix is more towards these high margin businesses, we believe that the CAGR, the cumulative, the compounded annual growth rate in terms of EBITDA is going to be faster for Inox versus PVR. And also the stock is trading at, I think, about 35% lower in terms of EV/EBITDA multiple versus a PVR. So we think that there is going to be a bridging in terms of EBITDA margins and return on invested capital between PVR and Inox over the next 2 to 3 year time frame, which would lead to some of this EV/EBITDA multiple discount that Inox is currently trading at also getting bridged to a very large extent. So that is what is driving our bullishness on Inox versus PVR. But we are bullish on both on an absolute basis.
Just one question, Mr. Pai, again, while actually the discount in terms of what Inox will be trading, that actually provides a very good opportunity for the investors here over a medium time frame here. But suppose if somebody actually was looking at the release calendar for this year, and then again, if you are actually trying to think what the first 5 months have provided as good box office collection, higher ticket pricing, higher ad revenue, higher F&B again revenue also here. So from that perspective, what's your own sense right now? Has the market already priced Inox for this year growth, or you think perhaps we still have some X factor here, some alpha opportunity here for the investors here for this year?
See, I would say that one should be investing in Inox and PVR more from a 3 to 5 year perspective and not so much from a very near term perspective. I think there could be earnings volatility for some of these companies depending on the release calendar that you talked about and how well some of these releases are accepted by the audience. So the occupancy levels of the screens kind of go up and down depending on the content or the quality of content, and the reception of the content by the consumers come through. So I would think that if you take a 3 to 5 year perspective, I think this is a good consumer discretionary space in the market to focus on. As I said, there are fairly high entry barriers, and we could potentially ride out some of the volatility from a content release perspective and the volatility that it kind of brings in. So this is a call more not so much from a 6 to 12 month perspective. It's more a call from a 3 to 5 year perspective. I think the stocks can potentially give you maybe 25% plus kind of a CAGR return if you take that kind of a view.
Right, so that's the take coming here on Inox. Again, 376 is the target price from Nirmal Bang here, and that's what again Mr. Pai is explaining here. At present trading at more than 30% discount to the PVR. So if you like the movie space, if you like the exhibition stocks here, perhaps between the two, Inox actually is trading at relatively much higher discount to PVR here. And that's actually the take coming here from Mr. Pai. Mr. Pai, the second one from the consumer durable pack, IFB Industries. Why you like that stock? And I have two questions here. Number one, reliance on washing machine growth, AC presence, market share still lower. But what we should be actually really looking into this stock in terms of value creation, why actually this stock, the earnings perhaps, on what growth drivers perhaps the earnings actually are really relying on?
Yeah, so we are very bullish on the consumer appliance space. If you take a 5 to 10 year perspective, I think there is a lot of room to grow for this particular space. So there are a bunch of stocks which have delivered huge returns for investors, be it Havells, be it Crompton Consumer, be it IFB, Whirlpool. There are a bunch of stocks which have delivered huge amount of returns. See, I think at the industry level perspective, what is attractive is penetration levels are fairly low. So ACs are probably at a 5-6% penetration level from a household perspective. Washing machines are probably at 11-12% penetration within households in India. We have refrigerators which are probably at 20 to 23%. Television sets, color television sets are probably at 55% kind of penetration levels, which is probably the highest within the consumer appliance space. So penetration levels are fairly low, and these are aspirational products for a lot of Indian families. So as incomes grow, we think that these are products that will be bought by the Indian population. The other thing which is kind of, there are a whole lot of other factors. So penetration is one. The fact that consumer durable finance is more easily available now with penetration of some of these firms within the hinterland of India. Electrification, more housing units coming up. So these are factors which are structural factors driving the industry. Now, specifically for IFB Industries, what we like is the fact that the margins of the company are fairly low right now compared to its peer set. So peer set is anywhere between 10 to 13-14% EBITDA margins, whereas if you look at IFB Industries, 9 months of FY18, it's delivered about 7.3 or thereabouts.
But Mr.
So
Pai,
we think that
just one question. I just want to interrupt you and just also ask you add one question here. Is that in terms of the product it's already operating in, for example, washing machines again, where it has actually taken market share, the margins you were just ascribing to, ACs again still in terms of preferential choice. it still actually is not coming in the top of the pack rankings as a consumer preferential choice here. And given the fact, if I'm looking at the multiples, they are almost 80-81, trailing 12-month earnings. Perhaps the next 12 months could be looking slightly higher on the earnings here. But PE multiples also actually are not looking that inexpensive here. So from that perspective, what would be actually that sort of lever here? Is it margin expansion which you are ascribing, or you actually are seeing much higher volume growth or new category entry? Like, what's the factor here?
So we think that IFB industry is going to deliver both industry-leading revenue growth as well as industry-leading margin expansion. So I mentioned about the fact that its margins are way lower than its peer set in the industry. But if you look at the gross margin of the company, it has been above 41-42%, and this is actually the industry-leading gross margin. If you look across consumer appliance players. But if you look at the EBITDA level margins, they are lower because one, the cost structure is a little higher. Because the fact that it's been importing some of the components that it puts in its washing machines. So one of the reasons why we think margins are going to expand. So we expect margins to expand by 500 basis points between FY17 to FY20. So from 5.6% in EBITDA margin FY17, we think that EBITDA margins can go up to 10.6%. Which in our view is going to lead to an earnings CAGR of about 40-45% between FY18 and FY20. So I think there are going to be very few companies in the Indian market which are going to deliver you a 40-45% earnings growth over the next couple of years. Yes, you may be right from the perspective of looking, if you look at a trailing 12-month perspective, the stock may be looking expensive. But what I'm saying is that look at the top line growth, which we expect to be 20-22%. Bottom line growth of about 40-45% would mean that the stock is probably trading at a discount to some of the other peers like say a Whirlpool or some of the other consumer appliance companies from an FY20 perspective, where some of these companies are going at maybe 33, 35, 36 times FY20 earnings, whereas this company in our view, based on our earnings, we think that it's going at maybe 25, 26 times. So there is a gap to be bridged there. We think that that margin expansion story is what we think is going to drive earnings, and we think that is going to be driven by two factors. One, the fact that there's going to be greater localization of components going forward. Secondly, we think that it is going to get into some more categories. So it is planned to get into refrigerator category, which is one of the largest areas of the consumer appliance market. Starting FY19, it's going to get there. It's going to expand its distribution network a lot more than where it is right now. So this is what's going to drive the earnings growth picture of IFB Industries, and therefore we think that it represents a good bet. Margins will expand. We think return ratios will also commensurately expand going forward. So we think that they will probably go to the 35-40% plus levels by FY20. So we think that the 25-26 times FY20 for IFB versus a 35-36 or 35-40 times for some of the other consumer appliances unjustified, and that bridging of gap should happen over the next 12 to 24 months is what we feel.
Absolutely, yeah. So that's the IFB Industries for you. And I like especially again what Mr. Pai was telling. One again is entry into a new category, refrigerators. Again, that is something which is a high volume space. Again, very keenly watched also here. And number two, again, lower imports of the components would also imply margin expansion. That was Mr. Pai again was ascribing to. So two levers, perhaps you should be keeping a close eye. 1,900 rupees is where again Mr. Pai actually looks at the stock, which perhaps could be heading for here. So material returns, but I think entry in refrigerator category perhaps could be also a path mover for the stock, and that's where I think the next orbit perhaps could be coming from. So Mr. Pai, thanks a lot for providing us all the insights into the two top stock picks, Inox Leisure and IFB Industries, and also telling us about what a dollar rally perhaps could be implying for the IT sector here. And that was all we had on this edition of Market Guru from the entire team here. Thanks a lot for watching us.